Is this the start of a dream run for Indian equities? That question to Ridham Desai, Managing Director, Morgan Stanley. Good morning, Ridham. Great to have you on perhaps what is a seminal moment for Indian markets. What is the sense you're getting? Should we go with all these, bunch of brokerages who are telling us 8,500 and 8,600 is around the corner, or 28,000 on the Sensex? If it is, how quickly is it?
Yeah, good morning, Lata. Great to be back. I think it's a question of time frame. So if you're looking at this from a 2 to 3 month perspective, I think 8,000 is unlikely. But if you look at it from a 2 to 3 year perspective, I think what we have seen here today so far, say since October or August of last year, may just have been the beginning of a new bull market. And we know how these bull markets can go. There will be considerable more upside over that time frame. So my view is that you want to buy the markets on any opportunity that you get. It's quite possible that it consolidates at current levels, or maybe even it dips. Some bad news comes in, the market takes a little bit of a negative turn. Then you remind yourself that you're actually in the middle of a cyclical and a structural upturn for India's story, and therefore you go and buy equities. So my bias is to buy equities, but the near-term upside may not be as high as 8,000 as some people may be suggesting.
Okay, now let me just flip this question simply because Ruchir Sharma brought this analogy in of the Reagan-Volcker moment. Reagan's first year in office, 1980, he comes in November. 1981, the markets fell 10%. They had the biggest recession going because something had to be corrected, a huge several-year, multi-year inflation. Is there any chance at all that can, not a 10% market downfall, but actually an underperformance?
No, actually, Lata, I think there's a difference here between what happened in America in 1980 and what is happening in India, which is that actually the outgoing government had already started putting in place policy to bring down inflation. So, we have seen these successive diesel price hikes, we have seen fare hikes in railways. So, we have seen some reduction in subsidy, not a whole lot, but some reduction in subsidy. So, we are seeing that wage inflation in rural India is also tempered from the highs. Now, we have not achieved enough, there's more to do, but we're not starting at such a bad point. Our forecast is that inflation will actually go back down to 6% in the next 6-7 months or 8 months. Now, when it does go back to 6%, and I'm talking about the CPI, Lata, it will be the lowest inflation rate in 8 years.
Absolutely.
For the first time in 8 years, it will go back to RBI's comfort zone. So there's not that much work left to be done. If we don't bungle on government expenditure, on consumption expenditure, then the likelihood is that inflation will start receding. And if it starts receding, real rates turn positive, then I think the outlook for equities will be quite bright. So I think there is a difference. There is a similarity also in terms of the structural possibilities, which is that marked the beginning of a long-term bull market in US equities, which lasted for nearly 20 years before the Nasdaq bubble happened. And we could be in a similar type of a 10-year run, as we pointed out in a report that we penned last week called The Next India, which is that India is one of the most attractive destinations for capital over the coming 10 years. So the structural story could be overlaid with a cyclical upturn. So in that sense, there could be slight differences with what happened in the US in the early 80s.
Ridham, hi, good morning. This is Sonia. It's good to have you on the show this morning. For the first time in so many years, the market actually got what it wanted. And from here on, because it is the largest majority for a single party in, say, 30 years, there's significant legislative firepower that the new government will have. What are the first couple of low-hanging fruits that you see that the new government could unleash? And how soon do you think we could see policy debottlenecking?
Yeah, good morning, Sonia. I think, Sonia, actually the low-hanging fruit is on the executive side and not on the legislative side. But the point on the legislative side, I think, is noteworthy, which is that this government, with its current Rajya Sabha membership and Lok Sabha membership, has 50% of the seats in the combined house. That is important because lawmaking in India has a provision where if one of the two houses rejects a bill, then the President can call a combined session, and then you need a simple majority in the combined session to pass the law. So in a way, it is unprecedented. We have not had such lawmaking authority vested with a current government since 1984. But I think the focus right now should be on executive decisions. There are some really simple, straightforward things to do, whether it's the matter of unwinding the large subsidy bill that the government of India has and therefore bringing down the fiscal pressures, whether it is unleashing capital productivity. Mind you, the ICOR is halved in the last 5 years. So India doesn't need a new capex cycle. All it needs is better capital productivity. So it needs to unlock some of these projects that are not actually producing any output but are sitting out there, or some of the half-done projects which are waiting for approvals. Or if it is concerning the matter of deleveraging the private sector or recapping the SOE banks. These are executive decisions. You don't need to invoke any legislative power to do these. And I think those are the first things that the government should embark on.
Okay, Ridham, starting tomorrow, or maybe 21st, I believe, around 21st when the oath taking happens, what will you watch out for? Will you watch out for the quality of the finance minister, or will you watch out for the budget? And in the budget itself, will you be terribly disturbed if the deficit is as high as last year's, 4.5% or 4.6%, and not the 4.1 that the vote on account stated?
Well, Lata, certainly the market will be focused on the formation of the cabinet. The large-scale expectation is going to be a much smaller government than the outgoing government. And there are expectations with respect to who the finance minister will be. I'll not get into those speculations, but the market will keenly watch this as a matter of great interest over the next few days. The budget, I guess, will be end June, early July event. And to me, the most crucial thing about the budget is the level of consumption expenditure that the government budgets. What is it that the government is trying to do in terms of consumption? What we've had in the last 4 or 5 years is elevated consumption expenditure, which needs to unwind. Even if it means that growth comes down for a couple of quarters, I think it's a pain worth taking, because what that will do is it will de-anchor inflation. It will make the central bank's task a lot easier, and it will set the stage for lower nominal interest rates in 2015. I think the central bank is extremely clear that it wants to de-anchor inflation. If the government can lend a helping hand by unwinding consumption expenditure, then I think we have a great story for 2015. So I think these are the immediate things on the horizon. And then, of course, all these other matters with respect to clearing projects, in respect to setting up processes to privatize resources in India, I think will be very crucial. So these are the things that we should immediately look for.
So how much do you think realistically this market could re-rate on a valuation basis, say in the next 1 to 2 years?
See, Sonia, I will give you the illustration of what happened in 2009. In 2009, when the election results hit the market was trading at 18.5 times trailing earnings. Today it is trailing at 18.8 times. Then also the market got very optimistic that the new government will lead the charge on reforms. By October 2010, which is in the subsequent 17 months, the market's multiple went up to nearly 24 times earnings. So it's not impossible for this market to actually go to that type of multiple, especially if the market is given a policy agenda and policy execution. Now, if you look at my bull case on the index, the new target that we have, it is 31,000 for next year June. 31,000, and if you look at the Sensex earnings that we're looking at, it's about 1,600 odd. So we are looking at a 19-time multiple in June next year. It doesn't come close to what we got in October 2010. So it just lays down the upside that you can see. Now, I'll very quickly add that in the immediate term, a lot of people will struggle to see value in the large caps. And I certainly believe that the value resides in the mid caps. So if you're a value investor, then I can see the case for mid caps being a lot stronger than large caps. Either way, you want to own equities for a 3 to 5 year view, but if you're looking to own equities with a shorter term view, then maybe mid caps will offer greater upside than large caps. But that's how I think valuations are. They're not cheap. For sure, they're not cheap. but they have gotten a lot more expensive in the past before giving up, in the hope that there's a new earnings cycle. And certainly that hope, I think, is warranted right now, that we could be at the beginning of a new earnings cycle, which will roll out in, say, the next 4 to 6 quarters.
Okay, so, I mean, this is pointless asking. I mean, if you're looking at a 31,000 on the Sensex in a year, in June 2015, then Ridham, what are the leaders? What are the outperformers? Quite clearly...
No, Lata.
Sorry.
Yeah, no, let me qualify. That was the bull case. That's not our base case.
Okay, so your base case is?
You know, that's not...
Okay.
The base case is, the Sensex target that we have is 26,300. So that's a more modest 10% upside.
Okay.
It therefore assumes that you will get a bit of a correction and then the upside will become more reasonable. But I'm making the case for, you know, if it all got very bullish, and since Sonia's question was where the valuations can go,
okay,
you know, that is how they have behaved in the past. I would not make that my base case.
Okay.
So I think the 3-year upside is a lot better than the 1-year upside, because the earning cycle is still not panned out. In fact, if I have a moment, let me just explain that also.
Sure.
You know, the share of profits in GDP are now at a low point relative to the share of wages. This is exactly the opposite of where we were in 06. In 05, you know, we had penned a note called the coming wage inflation. In the last 8 years, we have had massive wage inflation, and therefore profit share in GDP has dropped. From here on, I can see a reversal in the two, which is that the share of wages in GDP will drop and the share of profits will rise. Therefore, the first thing that you want to do is avoid consumer staples. Staples have been a big beneficiary of this rise in wages. So coming to your question on what sectors and what trades, I think staples, which are sitting on all-time high margins and near all-time high valuations, could face a double whammy, which is declining profitability as well as declining multiples. So that could be a sector that could go through a derating. In contrast, I think private banks will continue to do well. I think energy is a sector where I see massive earnings upside and a lot of valuation upside as well. I think materials is another sector which looks interesting. I'm a little bit more cautious on industrials. I think the industrial stocks have done too well, and they're assuming a capex cycle very quickly, whereas I think first we need profitability in the corporate sector to turn, return on equity to rise, and then we'll get a new capex cycle. So we may want to buy the companies that own infrastructure assets, but not generally speaking capital goods stocks. Because they are quite richly valued, especially the large cap ones.
I'm waiting for the
those would be
financial
the stocks and trades that we'd back.
Waiting for your take on financials.
Yeah, see, in the financial space, I think the private banks, especially the smaller ones, the ones that are down the mid-cap, down the cap curve, I think look quite attractively valued. And therefore, those stocks should do quite well. The SOE banks still have a bit of a problem with their balance sheet. Now, if this government is willing to make a big call on SOE recap, then I think there will be considerable upside after that. So I would actually wait, because I don't know if that call will be made in the immediate future.
Okay, well, Ridham, I'm glad you clarified your Sensex target. What's your bull case and what is your bear case, or your base case? Because our jaws were dropping here. But nevertheless, you know, the growth story looks very good right now, the impending growth story. But there are still some serious event risks. I mean, there's El Nino, there's global geopolitics, and of course, inflation that breathes down our neck. Do you see any of these derail the market movement at this point in time, at least?
So, Sonia, my question to you is, when did we last get an El Nino? And it was 2009.
Okay. Yeah.
It had no impact on the market.
It didn't.
It had no impact. 2009 was an El Nino year. The index, you know, may have retracted for 15 days because the monsoons came late and they were below average. And in fact, the drought in 2009 was the worst that we've had, second worst drought in India's history. And yet, it did not actually leave a meaningful footprint on market performance.
No, but the reason I ask, Ridham, the reason I ask is because, you know, in 2009 things were very different. We were recovering from the 2008 phase. At this point, we're already at the peak, and we've already done, what, about 30% since Modi became the Prime Minister nominee. So, you know, things are quite different if you compare it like that.
No, actually the markets in 2009 going into the election results were already up 60% from the low point. So they were up a lot more, and in terms of multiples, they were trading at nearly the same multiple as they are trading today. Again, I don't want to get drawn into the 2009 debate, but the point is that El Nino may be a temporary factor. it's not going to produce a protracted correction, I think, in my view. Even if it's a severe one, we don't know as yet. I would say the global factors are most crucial, because for India's growth story to get supported in the near term, we need support from the world, which is that the world growth should not roll over. And to that extent, what has happened in the recent days in the US bond market, I think, is of extreme importance. The bond markets in the US are suggesting that US growth is rolling over. So bond yields, as you know, are falling in the US, and that's creating a lot of nervousness even in the equity markets. Indeed, if the bond markets in the US are right and growth has slipped in the US, then it will bring a problem for India, because one of the things that is supporting India's growth is the fact that global growth is getting better. So while we are fixing our own domestic issues, we cannot tolerate a down cycle in global growth. So to me, that should be the most important risk factor. Of course, expectations from this government are also high, and for a moment we are assuming that they are justifiably high. But if later on that proves to be a false expectation, then of course this will go through a much steeper correction than we are envisaging right now. So those are the two most important risk factors, I think.
All right, we'll let you go on that note. We haven't had our fill of questions to you, but postpone them for a later day. Thank you very much, Ridham, for joining us.